Well, hello everybody. This is Dave Burkas for the Burkas Report on Business. Today's subject is how much is your company really worth? It's a great subject. It's one we're going to work now by talking about methods of valuation. So let's look at 10 methods of valuation very quickly. The first is multiples of revenue. Typically, a company will receive between 1/2 and 4 times annual revenues in a sale. Now, that depends upon lots of things, including the industry, the speed of growth, and lots more. And in fact, a business today that is a cloud-based system, or a SaaS business as we call it, can have 6 to 10 times revenues. And in fact, there are many times in which even more is paid for technology companies as well. But 1/2 to 4 is a good number for a rule of thumb. Second is the price-earnings ratio. We often hear about this in the public market, but private buyers also look at this number, and the number usually comes between 5 and 30 times net earnings before tax and interest. And this number can be changed too, depending very much upon other things such as speed of revenue growth. Number 3, one not often used. In fact, I have to admit that is often used for companies that are trying to use the seller's cash in order to help the buyer make the acquisition. The free cash flow is how much cash is being thrown off by the company each year. And it looks like the real number usually comes between 5 and 8 times the available cash that is thrown off each year. Number 4, the book value of a company is not important for a tech company that normally has a very low book value, but very important for some companies with high numbers of assets, high amounts of assets. And that number can vary between 1 times book and 3 times book. Book value is determined by taking the total amount of assets less the total amount of liabilities, leaving the equity value or book value of the company. Number 5, what is the salvage or liquidation value? It's the floor or minimum value that is often used. And this would happen in a marginal sale when the company is going to be broken up and sold for whatever it's worth. Sometimes a software company's liquidation value is just the net value of the software and almost nothing else at all. And you'll find that to be a very low number in that case. So it is the floor for those that we look at. Number 6, the replacement value for the assets that the company holds. Well, that's something that you can consider for any kind of business. What would the replacement value for a buyer be if they had to reproduce your software from scratch all the way to the point where you are right now? As well as your relationships, your customers, and everything else, that replacement value is intangible, but it is real. On the other hand, if you are heavy in assets, what would the replacement value of those assets, sometimes even assets written off to zero on the books, be if the buyer had to go out and replace those assets? A great example would be a chip manufacturing company with very new equipment that died because it had, for instance, the wrong marketplace, the wrong chips, whatever the reason, and a new company coming in using that equipment might value that company at replacement value, which might turn out to be a pretty big number. Number 7 out of 10. How about similar company transactions, even in the private marketplace? Think of Crunchbase and others that have lists of transaction values. It's a way of a buyer finding out and the seller beginning to see the value of a company based upon how others are valued when they sell. And then we have to worry about number 8. What recent transactions have you had in your company that will set a floor or at least a value that people will see when they do their due diligence? For instance, have you sold some shares to employees, or have you bought back shares from employees? And how about an ESOP plan or a 409A appraisal? What else has happened that sets your valuation in a way in which people can see it? Number 9, if you have an internal rate of return that can be calculated by discounting the future to the present, then your projections, if believed, might be able to give you a higher value as well. It's not often used, but it's one that is used for fast-growing companies to justify a higher price. And then there is that, number 10, comparable public company valuations. Here's one that are easy to find. The difference, though, is that often a buyer will discount a private company up to 30%. For not being liquid, like a public company's transactions would be. And that's a pretty valid thing to do, although some of our high-flying companies today have not had that liquidation or public company valuation discount, and they've been actually valued higher than when the company went public. And then, of course, there is the one I've discussed before and won't spend much time on right now, the Burkas Method, which is a very simple way of doing this. It's widely published, as you know, and it's for very early stage companies, in this case, when trying for the sale. And often it is used for companies that are sold way before revenue. So let's talk about it again in that context. Last time we talked about it in the context of an investor. So there are 4 elements. I'll do them very quickly. One is the interest of the buyer for the company creates a floor price, often $500,000 or less. And then there are the things that a buyer looks at. An acqui-hire is the definition of a buyer buying a company for its management. So is the good management team in place, and will that give you up to maybe another $500,000 in value? How about strategic alliances? The buyer might be buying these things to be able to get access to your audience, and that's worth some money, up to $500,000 in this form. And then do you have a completed product the buyer can use and sell to its user base? That could be worth up to $500,000 as well. And then we get into revenue, and we get back to the first 10 that we discussed before. Well, that's it. I want to just note in passing that I've written 14 books, and they're all available on Amazon under my name, Dave Burkas. And these 3, the Burkonomics series, would be interesting to you because they're broken up into 7 chapters with 100 articles, and the 100 articles talk about entrepreneurs who have sold their companies, built their companies, successes and failures, and the lessons that have been learned. You might be interested in that. But either way, this is Dave Burkas for the Burkas Report on Business. See you next time.